Basel III, gold is established as a Tier 1 asset and transforms the foreign exchange market. Starting July 1, 2025, Basel III regulations and in particular its end-of-game rules will come into effect, marking a turning point in the global financial system. This regulatory framework aims to strengthen the soundness and resilience of banks, but its impact goes far beyond. It redefines the role of gold and could alter the balance of the global foreign exchange market. Gold as a Tier 1 asset. One of the most significant transformations is the new status of physical gold as a Tier 1 asset. This means that, for capital reserve purposes, gold is equated with cash and U.S. Treasury bonds and can be accounted for at 100% of its market value. This strategic shift seeks to incentivize banks to hold more physical gold, moving away from their dependence on paper gold and consolidating the precious metal as a zero-risk safe haven asset. According to U.S. global investors, this measure could translate into greater institutional demand for gold, strengthening its position on banks' balance sheets and increasing its relevance in the global financial system. Impact on the foreign exchange market. The strengthening of the gold market not only affects the metal itself but can also have indirect consequences on the value of currencies. As gold gains prominence as a strategic reserve, it could influence the perception of monetary stability, altering confidence in certain currencies and affecting their price against gold. Furthermore, by improving risk management and strengthening bank balance sheets, Basel III seeks to reduce volatility and the likelihood of financial crises, promoting a more stable and predictable foreign exchange market in the long term. However, during the transition and as banks adapt, initial volatility in financial markets cannot be ruled out. Other economic effects. The regulations could also impact liquidity and activity in capital markets, especially in the United States, where some analysts anticipate a reduction in trading volumes and a tightening of credit conditions. This could affect key sectors such as housing and economic development, and even have a slight negative impact on medium-term GDP growth. The effect of Basel III on currency prices will not be direct, but rather a consequence of its influence on global confidence, gold demand, and financial stability. Gold is expected to consolidate its role as a key safe haven asset, transforming bank strategies and potentially altering the global monetary balance. The entry into force of these regulations symbolizes the beginning of a new financial era, where soundness and security prevail over risk and speculation. In this context, gold shines not only as a precious metal but as the new golden pillar of the global banking system.